Welcome, entrepreneurs! Today, we're diving into a crucial topic that can significantly impact both your tax savings and your peace of mind: effective record keeping and audit preparation. Keeping accurate and organized financial records is essential for maximizing tax deductions, ensuring tax compliance, and being prepared for potential audits. By the end of this session, you'll understand the types of records you need to maintain, how to organize them, and what to expect if your business is audited by the IRS. Let's get started. Let's begin with the importance of record keeping. Keeping accurate records isn't just about being prepared for tax season, it's about staying compliant with IRS regulations and gaining insights into your business's financial health. Here's why it's so crucial. Tax compliance. The IRS requires that businesses maintain records to substantiate income, deductions, and credits claimed on tax returns. Without these records, you risk disallowed deductions and potential penalties. Financial insights. Good documentation helps you track your cash flow, assess profitability, and identify areas for improvement in your business. Audit preparedness. If the IRS ever audits you, having organized and accurate records can make the process smoother and less stressful. In fact, the better your documentation, the faster the audit can be completed, sometimes even favorably. As an entrepreneur, there are several types of financial records that you should maintain to ensure you're compliant and ready for tax filing or an audit. Income records track all income sources, including sales receipts, invoices, contracts, and bank statements. These records help substantiate the revenue your business generates. Expense records. Keep receipts for all business-related expenses, such as supplies, travel, meals, utilities, and rent. This documentation is key to justifying your tax deductions. Asset records. If your business purchases equipment, vehicles, or real estate, you'll need to document the purchase price, date, and depreciation schedules to track their impact on taxes. Liabilities and loans. Maintain records of loans, leases, and credit obligations, including terms and interest rates. This helps track deductible interest payments and ensures accuracy in your liabilities. Payroll records. If you have employees, keep detailed records of wages paid, tax withholdings, and benefits. Payroll taxes are closely scrutinized by the IRS, so these records must be precise. Now that you know what records to keep, let's discuss best practices for ensuring your documentation is accurate and up-to-date. Organize documents. Whether you choose a digital system or physical filing, organize your documents by category: income, expenses, assets, etc., so they're easy to find. Use cloud-based systems like Google Drive or accounting software like QuickBooks to streamline this process. Update records regularly. Set aside time each week or month to update your records. Don't wait until tax season. It's much easier to manage your finances when you handle documentation on a regular basis. Backup data. Always back up your records. Use cloud storage for digital files or an external drive for physical records. This ensures that you won't lose important documents due to technical issues or unforeseen events. Use technology. Invest in accounting software or expense tracking apps that can automate much of the record-keeping process, reducing errors and saving time. These tools can sync with your bank accounts and categorize transactions automatically. By following these best practices, you'll have a clear and organized financial record, making tax filing more manageable and audit preparation much simpler. Let's talk about something that every entrepreneur wants to avoid: an IRS audit. But if you're prepared, the process doesn't have to be scary. Here's what you need to know about the different types of IRS audits and how to prepare. Types of IRS audits. Correspondence audit, the most common type. This audit is conducted by mail. The IRS may request specific documentation to clarify certain items on your tax return, such as proof of deductions. This is usually the simplest form of audit and can be resolved quickly with the right records. Office audit. In this type of audit, the IRS may ask you to visit a local office to provide documentation for specific issues. This could involve more detailed questions about business expenses or deductions. Field audit. This is the most comprehensive audit, where the IRS visits your business or home to review your records in person. Field audits can cover multiple aspects of your return and require you to provide full documentation of your business operations. Taxpayer Compliance Measurement Program, TCMP. This is a rare and intense audit that reviews every aspect of your tax return. The IRS selects taxpayers randomly to ensure compliance across the board. Having meticulous records is critical in this case. Let's look at an example to understand what could happen if you're audited and don't have the proper records. Imagine David, who runs a construction business. He claimed $50,000 in equipment expenses on his tax return. Unfortunately, David didn't keep receipts or invoices for several major purchases. When the IRS audited him, he couldn't provide the documentation to support his deductions. As a result, the IRS disallowed the $50,000 deduction, meaning he owed taxes on the full amount. In addition, David faced penalties and interest on the unpaid taxes. If he had kept proper documentation, he could have saved himself thousands of dollars. To ensure you're audit ready, follow these steps. Keep detailed receipts. Always keep receipts for expenses, even small ones. If the IRS questions a deduction, having the proper paperwork is your first line of defense. Document business purposes. For expenses like travel, meals, or vehicle use, make sure you document the business purpose of each expense. For example, note who attended a business lunch and what was discussed. Review records periodically. Conduct periodic reviews of your records to ensure everything is accurate and complete. A quick check every few months can help you spot errors or missing documents before tax season. Consult a tax professional. Working with a tax advisor or accountant ensures that your records are in line with IRS standards. They can help you organize documents and prepare for any potential audit, minimizing your risk of penalties. In conclusion, effective record keeping is your best defense against a stressful audit and your most powerful tool for maximizing tax deductions. Here are the key takeaways. Keep records of income, expenses, assets, liabilities, and payroll to substantiate your tax return. Follow best practices like organizing documents, regularly updating your records, and using accounting software. Be audit ready by maintaining detailed receipts and documentation for every deduction. Understand the types of audits and how to prepare for each one to ensure compliance and avoid penalties. By investing time in proper record keeping, you not only protect yourself from potential audits, but also create a solid foundation for growing your business and making informed financial decisions. Thank you for joining me today, and I hope this session has given you practical insights into how to streamline your record keeping and be fully prepared in the event of an IRS audit.